Let people in, by the way.
Oh, let people in. I better stop cussing.
Stop cursing.
I got to clean up my language. Everybody's coming in.
So you're not going out for the holidays then?
No, I'm staying here for the entire holiday. I'm getting ready for 2021, baby.
There you
This
go.
real estate market's about to explode.
Yeah.
Hey, good morning, guys.
Morning, guys.
Morning. Good morning. Come on in.
See, everybody that's coming in this morning, they know what's up. They know what's happening in 2021. They want to get all their ducks in a row, right?
Massive opportunity in 2021, it sounds like.
Big time. Who we got
Yeah,
here today?
They're trying to figure out all the accounting stuff, be situated the correct way.
I see a couple of our students here. Daryl's here. One of our members, Dave Pinnell. Haven't seen you in a while, Dave. Hope you're doing good.
And Dave, I hope your sale finally went through, by the way.
Yeah, right.
I know you're working on some
Working on
big
a major
project.
deal. Yeah.
Good morning, guys.
We got a couple people here that signed up for our boot camp.
Good morning.
Good morning, Facebook people.
Good morning, Garaldi.
Wow.
I don't know if I'm saying your name right. Rowdy Joseph.
Hey, is everyone grouchy? We didn't even get one good morning.
Good morning, Joseph.
Yeah, if you're awake, type in good morning.
Nicole Beadle. Hello, Nicole. One of our favorite successful students, doing her thing, doing her business, blowing it up. Very proud of her.
Who's that? Nicole Beal?
Nicole Beal, yeah.
Oh, yes, she's awesome.
Yeah. Hello, Panita. It's been a little while since we've seen you, you and Ron.
Hey, good morning.
Hello,
good morning.
Good morning, guys.
Give me a heck yeah if you're sick of COVID, please. If that doesn't get you
motivated. Get more than a heck yeah, you better be careful. People are going to be like, ah.
If that doesn't get them motivated, then I don't know.
Yeah, exactly. Right? That'll get people pumped up. That'll get your blood pumping. I don't know. I see these interviews with these people getting these vaccines and stuff. It's a little experimental.
Yeah, I don't.
You're in the experimental phase right now. It's like, you know.
I saw a post from a doctor who was concerned about what they were putting in there, in terms of. I can't even remember what she said, but she was concerned that they were putting active, something that reads what's going on with your body, and that was.
The conspiracy theory is that the vaccine is now some type of tracking device that everybody's going to get shot with.
They're going to be so bored when they track me. They're like, oh yeah, he's just walking up and down the street.
Yeah, right.
They're going to find me at home every night.
Right.
I think we'll be okay.
You guys going to do the vaccine, you think?
Yeah. And guys, just as you guys already know, we'll have polls going throughout the day so we could get a better understanding of who we're talking to. As Jose, starts talking about our favorite thing, taxes and tax planning, gives us a better idea, what your experience level is too. Generally speaking, I know you guys are probably sick of this. You got questions, please put them in the Q&A. The chat just moves too quick. We'll probably miss it. Also, if you put them in the Q&A, if we answer them, everyone will see the answers too. So it's a little bit easier for everybody too. So
yeah, we'll try to answer all the questions. We only have an hour and a half, but we'll try to cover as much as we can. We're going to make this conversational because I know people are tired of presentations and they can be a little boring. So we'll try to make it more interactive.
Not this presentation. Be boring.
Yeah, I thought tax planning is awesome. I'm pumped.
Well, the tax savings are awesome. Absolutely.
It's true though. Like once you actually have it, instead of I know a lot of people are fear-based, about their accounting, their taxes, and no one wants to do it. I think really, the truth is that when you come up with a plan and understand it to an extent, it actually, I know it sounds kind of nerdy. Me and Jose are a little bit nerdy like that. We like our numbers. So I think it's just once you get control of that, you're going to see how it works for you. And by just some simple strategies that Jose's been talking about for years, actually,
right.
When you put an extra $5, $10, $15, $20,000 in your pocket, You're like, okay, so tax
Makes
See,
planning
that,
is
that
not.
that's the only time that I get excited about it is when like Jose's like, yeah, I saved you guys 15 grand. Then I'm like, oh, okay, now I love this numbers thing. But until I hear that,
Right. Not only that, but you know, the savings are every year, as long as you're doing the tax planning consistently every year, not just 1 year, right?
yeah.
So it adds
Wait,
up.
just out of curiosity in the chat, how many people are actually have done any kind of tax planning? Just kind of curious. Well, I won't even put a poll. I'm just curious to see. Yeah, or you could write and be honest and say, what is tax planning? Never heard of it.
Tax planning, what's that?
What's that?
Taxes. What are taxes? I'm not, wait, we have to give money to the government of the money that we make?
Well, it is South Florida.
Yeah, that's true.
Daniel, yeah, 2 years. Karen, a little bit. Okay. Done taxes. No tax planning. Okay. It's good to be honest. It's okay. You know, just that's why you're at the right place. So.
Yeah, exactly.
So it is 7 after 11. I think we should probably get started. We don't want to penalize the people that are showing up late. You guys get points for just showing up early today. So
Excellent.
Hmm.
We got a good number of
so
attendees. So good.
So welcome, guys. My name is Anish Dave, one of the owners of the Broward Real Estate Investors Association, the Miami-Dade Real Estate Investors Association, and WJL Properties. That's a mouthful. So I know a lot of the names. I feel like I already know everyone here that's on the webinar, but in case you didn't know us, Ryan and I, we've owned Bria for the last, it's actually been over 6 years, and we bought the companies from our mentors. Our company, you know, what we focus on is education, networking, and we're actual investors too. So we have great vendors like Jose, or partners, I call them actually, that really, you know, open our eyes about tax planning, tax strategies. I don't want to be a tax planner, right? I know Ryan doesn't want to either. So instead, you just run it by Jose. So the key is to really have great partners. We've been very lucky, if you want to say, if during this COVID period, meaning, you know, Jose's probably done 4 or 5 webinars with us throughout the process. And, you know, he's constantly bringing more education. And I know you guys have been asking for more of Jose. So Jose, you got your own little fan club of people. So I guess there are a lot of people that are finally interested in tax planning, tax strategies. So, you know, welcome, guys. And also Ryan, I mean, most of you guys know Ryan, president of National RIA for 2020, 2021 also. You know, we've been partners for 20 years, and, you know, we've really expanded our business even during COVID time too. So Ryan, I don't know if you want to give a couple of quick words before we get to Jose.
Yeah, I just listen. I'll tell you guys. You know, being partners with Anish, he calls himself a nerd. He's not really a nerd, but he's a smart, and he knows and understands a lot of financial. He's in banking for a long time, and it's been an advantage to me because he knows that I am just so not that guy. I'm horrible with my finances, and having a business partner like Anish, and then having, you know, one of our corporate members, a friend and partner like Jose, has really started to open my eyes to really kind of, you know, grow up and become a businessman finally. And just everything that we've done collectively, and you know, the insights and planning and stuff that you know, we've gotten from Jose. You know, Anish getting me into, you know, my Roth IRA retirement account that now I'm you know, getting funded and I'm actually going to have money for my retirement in. Guys, you know, sometimes it is a little bit, you know, numbers and math and all of this kind of stuff is not necessarily as exciting as you know, as other aspects of real estate, but it is ultimately very important, and it's very important. We wouldn't be doing these kinds of things if it wasn't. And, you know, despite what Jose might have said in the beginning about being boring, I think he does a great job of explaining everything. I think he, you know, he does make it interesting and make it fun as well. So make sure you guys pay attention and follow up with Jose. Don't just attend these, you know, these webinars, actually sign up and start getting some services for your businesses as well. So.
Excellent.
So take it away, Jose.
All right. Good morning, guys. Jose Ramirez, Chief Tax Strategist with Advanced Tax Advisors. A lot of you already know me. I see a lot of familiar names. We're tax advisors specializing in the real estate industry. So we're going to talk about some strategies that we use here, some strategies that I personally use, and we'll try to make it fun. We'll make it conversational. I do have slides, and I went back and forth on whether I should do slides or just kind of like have conversations and answer questions. But I think to keep us on track, we should probably do the slides. All right, so let's get started.
Yeah, we'll be able to do both. So again, this webinar is really for you guys. We've outlined a few things, that Jose wanted to really touch base on, but we could always change the conversations pretty quick. I do see a lot of you guys are new to real estate investing. No deals yet on that end of it. So it's important to learn about tax strategies and planning beforehand. So when you do start making some money, you know what to do with it, or how to structure it in the beginning. For the people that are already doing deals, Jose could fix things. It just might cost you a little bit more money to set up the right structures. Right. And a lot of times, you just don't ever think about it from the beginning. So
yeah, for the newbies, what's going to be important for you guys, the newbies, the entity that you operate under is very important. All right, so don't assume that the entities are all cookie cutters and an S corp is for everybody, or a C corp is for everybody, or an LLC. You have to really determine where you are in business, what activity you're going to participate in, and figure it out from there, right? And for the more experienced investors, the ones that are making more money, I mean, you got to consider things like cost segregation. If you're a landlord, cost segregation may be a good opportunity to reduce your income, your taxable income. And I'm going to go over a few, but those are a couple of examples to get going here. All right, so I get questions a lot about the SBA loans. So I'm going to talk a little bit about that because they're still open till December 30th. You can still apply for these loans. For one loan, the EIDL loan, which is the Economic Injury Disaster Loan. If you have not applied for this loan and you feel like you need it, you have till the end of the month to apply for this loan. All right, you are going to need financials. So if your books are not clean and in order, you're going to have to clean those up before you apply so you can submit correct information. All right, everybody with me on that? I'm curious, how many people have applied for the loan, or how many people have not, and what's the reason behind it? If you can put it in the chat.
Yeah, just put it in chat. How many people I have? I got an EIDL.
I got an EIDL. I mean, I just did it just in case. I mean, I haven't had to use it, but.
Yeah, same thing for us. Just because you don't know, but having your ducks in a row, like obviously we have all our financials up to date, so it's pretty easy actually. So okay, I see a couple people got an EIDL. Okay.
I'll be paying it back before the end of the month. I think I don't need it, and it's I don't want to pay the interest. So there you go.
Do you actually, Jose? I got a question for you. Is
sure.
If you don't use it, obviously you have 1 year. Do you still have to pay the interest from the day you got it? Correct.
Well, the interest is deferred for the first 10 months, I believe. So
okay.
Deferred meaning that it's accruing. You just don't have to pay it yet. So if you don't need it, you still got to pay it. So might as well just pay it back. Okay, so the key things with tax planning, keep in mind that you have four components, right? 4 areas. You have timing, you have shifting, you have the code, and you have products. Timing would be things like kicking the can down the road, where you're gonna put some money away, like on a 401k, and then pay the taxes later, right? Shifting income would be hiring employees that are family members that are in a lower tax bracket. For instance, you hire your daughter or your son that's a teenager, 13-year-old, who works in the office doing administrative things. If you're a property owner, they're doing the maintenance in the property, things of that sort. So now the child is getting income tax-free because it's under the threshold. The threshold for the year this year is $12,400. So as long as you're earning less than that, there's no tax, right? But then your company, your business, your corporation gets a deduction on that payment. So that would be shifting income. The code would be anything on the code, like a cost segregation, passive activity, things that you can use to your advantage as long as you understand the code that applies to you. Products would be things like insurance. All right, so there's multiple components, things to consider when tax planning. I always tell my clients, try to be as aggressive as you can, while staying in compliance. This is a slide that shows you what the audits look like nowadays, the audit paranoia, as they call it. Most audits out there are going to be relating to Schedule C filers. So, and it's not high. We're talking about 1%, 1.9%, 2%, depending on your revenues. The least audited entities are going to be partnerships and S corporations. So something to consider, right? You have some peace of mind there. But even if you are operating under a Schedule C, the as long as you're doing everything right and you're applying the strategies correctly and you're documenting the strategies and documenting your receipts, saving copies of everything, you're fine even if you do get audited. So don't let the fear of audits prevent you from saving money in taxes is the point of this slide. All right, makes sense? Okay, now we're going to talk about the different entities, business entities. Which one is right for your activity, right? So we have, and a lot of people get confused on whether an LLC can be a corporation and vice versa. Corporation can be, so there are two different governments. Something to keep in mind is that you have the state level entity and you have the IRS level entity, all right? The two do not connect. The two do not communicate. The two do not care about each other, okay? So if you set up an LLC, that LLC is with the state. And then you have the choice to make it a sole proprietor, a partnership, a corporation, or an S corporation. You designate that with the IRS. Okay. So a lot of people, it's funny because when I ask the question, what entity are you operating under? And people a lot of times say LLCs. Okay, that's great. An LLC is great, but well, how is it being taxed? And a lot of people think the LLC is a taxable entity, and it's not. You have to know whether you're a sole proprietorship, you're a partnership, corporation, and S corporation. All right, so we're going to talk about these individually. When do you want to use a sole proprietorship? A sole proprietorship is good when you are self-employed, not much going on, you're just getting started. Like a single member LLC will be good for this. The requirements are that you have to make your estimated tax payments. So you're going to take your net income and multiply that by your tax rate and send those tax payments on a quarterly basis, right? It's simple. There's very little compliance to follow, no formality. You can use even your personal account to track your expenses, although I don't recommend it because you want to have some clean separation. The next one is going to be the partnerships. The partnerships is the default entity for any LLCs who have two or more partners. Okay, so if you create an LLC, you apply for an EIN with the IRS. The IRS is going to designate a partnership to you if you have two members. It still has some flexibility, right? It pays the 15.3 and self-employment tax if the owners participate in the activity and they're operating partners. Primarily is used to own assets like real estate or equipment. They're good for that. They're good for keeping assets separate from the active business. All right. The next one is going to be the corporations, the C corporations, as they call it. It's good for more entities that have more income, significant income, because then you can apply some fringe benefits. Your tax rate is capped at 21%. There is double taxation if you take money out of the corporation. The corporation pays the 21%, and then you pay tax as well via payroll or dividends. There's no restrictions on shareholders. So that's the biggest difference that's one of the bigger differences between the C corporations and the S corporations. You can have foreigners be owners of the C corporation, as opposed to on the S corporation, you can't have foreigners or non-US people, okay? There is corporate formality, meaning that you have to have director meetings, document the meetings, and things of that nature. All right, and lastly, we have the S corporations, very similar to the C corporations, with the exception that the S corporation has no tax. It pays no tax. It passes the income and losses to the partner. Most of us know this if you're already in business. There's some restrictions. The restrictions are that you can't have foreigners own the S corporation. You have to have a U.S. person. You have to be a U.S. person. There's no double taxation. We like these entities for active businesses that are performing, right? That are experiencing growth. They're netting over 50,000 a year, 100,000 a year, whatever the case is. This is the best entity to cap on the employment tax. Put a cap on the employment tax. All right. So why do we like S corporations for wholesalers? That is a great question. So the reason is because we can put a cap on the self-employment tax, and I'm going to go over an exercise here shortly. So with a sole proprietorship, if you just have an LLC, taxes as sole proprietorship, you're going to be paying 15.3% on the entire net income of that sole proprietorship. So you have an LLC with the state, taxes as sole proprietorship. Let's say that you're netting 80,000 a year. On that 80,000 a year, you're going to be paying 15.3% in self-employment tax, in addition to your ordinary income tax, wherever it is that you fall, right? Depending on your entire income as a whole. So 15.3 on 80,000, we're talking about $12,000. It's pretty significant, right? So how do we put a cap on that? By shifting that entity in an S corporation, you no longer have to pay the 15.3 on the entire 80,000. We can designate a salary for the owner that is reasonable, and reasonable has a broad definition, so we can have that discussion later. But assuming that reasonable in this case is half of the net income, right? So you pay yourself $40,000 in wages as payroll. And the payroll does pay the employment tax. It's no longer called self-employment tax. It's called employment tax or payroll tax at 15.3%. But now you're paying it only on 40,000. Okay, so 40,000 times 15.3, we're talking about $6,000 as opposed to the 12,000. So the savings are pretty significant. The balance of the 80,000 gets distributed to you as a shareholder distribution, and it doesn't pay the self-employment tax. It only pays the ordinary income tax, wherever it is that you fall, right? So this goes over the example in more detail. We have 80,000. On the left side, we have the sole proprietorship. You're paying $12,240 in taxes. On the right side, we have the S corporation, and it only pays $6,120. So $6,120 in savings. What would you do with that savings? Put it back into the business, marketing, whatever the case is. All right. A lot of people ask me when they're starting out, do I really need an entity? You don't technically need an entity, but it's always better, right? I mean, if you're operating under an LLC, it gives you more credibility. You have easier access to these hard money lenders, because the hard money lenders they actually don't lend you individually, so they want you to have an LLC. All right, so steps in preparing an LLC tax as an S corp if you needed it. The first thing you're going to do, and I hear this a lot. Yeah, I went to the state, I paid the fee, $125, and I got my name. Well, it doesn't end there, right? That's just the beginning. You want to make sure that you file your articles of incorporation or your articles of organization with the state. But then you got to prepare the documents. You have to have the minutes, select the shareholders or members, the board of directors, waiver of minutes, the initial minutes. You want to prepare the bylaws or operating agreement. And then you want to request via the IRS for your EIN. Okay, so if you're not doing all these things, you're halfway there. You're not completely set up correctly. So you want to make sure that you're doing all these things. All right, then if you want to operate as an S corp, you want to make sure that you file the form 2553 with the IRS. I hear this all the time. People think that they are operating under an S corp when they're not. And they think because they applied for the EIN on the IRS's website and they selected a box that says S corp, they think they're an S corp. That's not the case. The IRS needs to receive a form. They have to process the form, and then they're going to mail you a letter confirming that you are in fact an S corporation. All right, so keep that in mind. Don't assume you are unless you have confirmation from the IRS. You don't want to be filing the wrong tax return and things of that nature, because that can cost you a lot of money doing a tax return twice. Okay. And that's it. Then you go to the bank, you open up your checking account for the business. You want to have clean separation. Very important when you have an S corporation, you can't commingle the funds, right? You want to have clean separation between your business and your personal. If you don't, it could be very problematic. The corporation can't pay for your personal bills and vice versa. Then you apply for your occupational license if your city requires it. Get insurance if you feel you need insurance. If you have employees, you may need workers' compensation, and you're off to the races. You're in business. All right. Okay. So for the real estate investors, go ahead.
Wait, hold on, Jose. Let me answer. I got a couple of quick questions.
Yep.
It's a little bit on the side. I know you kind of touched on it a little bit. Alberta was asking, can you talk about taxes for foreign investors? So I know you kind of mentioned it. So let's say out of the country, and depending on, FERTA or FIR, was it FERTA or?
Yeah, depending on if you're talking about real estate investors, they have the
Mhm.
FERTA requirement where they have, if they sell property, the title company or the seller has to withhold 30% of the gross sales until they file the tax return. See, the reason behind that is that the IRS wants to make sure that these foreigners are not buying and selling property and not paying their taxes on the capital gains. So they have this authority on the seller by saying to them, if you are selling to a foreigner and you don't have the title company withhold the tax, the 30% on the gross sales, then we're going to tax you. So there's additional requirements when dealing with foreigners. So keep that in mind if you are dealing with foreigners.
And if you are, let's say, do you have any strategies? Let's say my partner's a foreigner, right? So, let's say I have a partner in India. I'm a US citizen.
Yeah.
Can we, and I know this is more like a one-on, this is your situation kind of thing,
No,
but
yeah,
are there
absolutely.
ways to
I mean,
mitigate risk?
I've heard of people trying to get creative, like,
Okay.
and I can tell you that, some realtors will suggest to the foreigner seller, oh, just put the property under an LLC, and then the LLC is the one selling the property. That's not the case. I mean, the LLC is selling the property, but the owner of the LLC is still a foreigner. So the requirement still applies. So when dealing with foreigners and investments by foreigners, don't depend on your realtor to give you tax advice. I mean, that's like asking your plumber for tax advice. There's no difference, right? What's the point in that? So you wanna make sure that you have the right information before you engage in business with foreigners or other kinds of requirements that are, for them basically. Make sense?
Absolutely. And as you're going, I'm going to answer, or I got another question. Do you know how to handle land trust taxes if there are any? So if you actually buy it in a land trust?
Well, land trusts are pass-through entities. They're not real entities in this, and there's no tax entity for them. So if
Exactly.
you own property under a land trust, it just flows through the owner. So there is no
Right.
tax.
There's no EIN number. There's no bank account,
Right.
any of the above. But
Exactly.
I know a lot of investors, they will buy it in a land trust. It's just so that basically you're also, if you do it correctly, no one knows what you own. So that's why
Yeah, and
people
I like land
buy.
trusts. I mean, I looked into them for myself. I mean, I spoke
Yep.
to one of the corporate members, Ray, I forget this Ray Pachin with Backlar. He does
Yep.
them. He does trusts.
Yeah.
So
Yeah,
he's a good person to
absolutely.
reach out to.
Yep, we do them all the time too. So, George, well, this is actually, he was just asking it's a little bit separate question. If I'm to set up a SEP, how do you calculate the max 25% if no tax 2020 is done? If your tax returns aren't done for 2020, how do you figure out the maximum SEP of 25%?
It's based on your wages. So whatever you pay to yourself as wages, 25% of that. So if you're paying yourself 100 grand, you can put in 25,000.
Got it. Okay, sounds good.
So how many investors do we actually have that are landlords? I don't know if that's one of the polling questions, but
Let me see. Yeah, actually we do. How
I'm
many rental
curious to
properties do you
know
own?
because we're going to talk about depreciation and All right. So answer that question, guys. I like to know how many actual landlords we have here, because the next topic is going to be on depreciation and the correct way of depreciating and accelerating depreciation, cost segregation. Okay, so we have several. 50, almost 60%. They have 1 to 5 properties.
Yeah, more than half of you guys own rental properties.
Excellent. Okay, good. So we're going to talk about depreciation and why is real estate so awesome, right? All right. So as you know, probably the reason you got into real estate is because you know that real estate appreciates over time, but you get to depreciate the asset and pay less taxes, right? Or pay no tax on the rental income, the passive income. So the way real estate works is you're going to separate the the components in the property, right? You got to separate the land. The land is not depreciable, never depreciable. You take the improvements of the property, whether it's residential or commercial. If it's residential, it gets depreciated over 27 and a half years. If it's commercial, over 39 years. Then you can identify within the property, you can identify what's considered improvements that get depreciated over 15 years. And you can also identify what's considered personal property. Personal property gets depreciated over 5 years. And if you can identify what these are, you can use what's called bonus depreciation, which I'm going to talk about that in a future slide. But bonus depreciation, because of the Trump's Jobs Cuts, Tax Cuts and Jobs Act, you can depreciate 5-year property and 15-year property using 100% bonus depreciation in the year that you place it in service or purchase the property, which has been huge since 2018, since the end of 2017, when it started, right? It used to be 50% bonus depreciation, but Trump changed it to 100%, which has been a big deal. It's helped a lot of investors reduce their tax liability significantly by utilizing the 100% bonus depreciation. So let's keep moving here. Let's see what we got. Oh, wait a minute. I go too far. Okay, so examples of what personal property is. It would be things like your kitchen cabinets, countertops, carpeting, dishwasher, appliances, anything that's removable from the property that is not attached to the property, okay? Is not permanently attached to the property will be considered personal property. Bonus depreciation, a temporary 100% expensing for certain business assets, first year bonus depreciation. It started after September 27, 2017, and it goes away January 1st, 2023. Now, there's talk about it going away sooner, but I don't think that will happen because of the new Biden tax plan, which is kind of ridiculous in my opinion, but nothing's happening yet. All right, so bonus depreciation. If you identify the cost of your, let's say, kitchen cabinets, countertops, carpets, machinery, and you apply bonus depreciation the year that you place it in service, you get to expense the entire amount. How do we identify what, when you buy a property, we'll use this example. When you buy a property, let's say you bought a duplex for 300,000. You back out the land. We know that the land, because you have an appraisal, the land says that it's 25,000. We'll just go with my example. For simplicity, it's 25,000. So now you're left with $275,000 in the real estate depreciable asset, right? Now you don't know what makes up that 275,000. All you know is that you received a HUD at closing that says you pay 300,000, and that's it. I mean, how much are the cabinets? How much are the appliances? How much are the floors? You know, the improvements of the property. The only way to get that is by doing unless you're buying a brand new property, you may have a better idea, but even then, you need a cost segregation study. Now, when you do a cost segregation study, the study will provide you with amounts allocated to different components in the property, meaning that now you would have a pretty good report that's going to show you the value for your cabinets, your appliances, your walls, your carpets. And by identifying what they are, whether they're 5-year property, 15-year property, or 27.5-year property, now you can use those numbers to accelerate depreciation. So this is an example of a report I did on one of my clients. So the basis after we backed out the land was 202, so not a lot of money, right? 202 is very low considering we're in South Florida. And we were able to identify in 5-year property 27,000 and in 15-year property 25,000. The balance was the 27.5-year property. So we were able to take the 27 to 25 and take it as a bonus depreciation in the year that he placed it in service, which was 2018. So that's an additional deduction. If you look up here, additional deduction of 52,000 in the year that he placed it in service, which equates to 18,000 in tax savings once you take his tax rate. Okay. Pretty powerful stuff, right? Here's another polling question. You guys want to, okay, so it's kind of like 50-50. Okay, so for those of you who have heard of cost segregation, if you're using it, great. If you're not using it, you want to get familiar with it because it's a very powerful strategy, especially for us, the real estate investors. Okay.
Yeah, I was going to say, Jose, until you actually brought it up, I never heard of cost segregation.
Really?
And then I realized, some of my mentors that have multiple properties, multiple deals, they all use cost segregation. So it made me feel better. I was like, oh yeah, well, I've heard of that now. So,
Right.
your regular accountant, and like I always say, all accountants are not created equal. If they're not, real estate, accountants or working with real estate investors, you're not going to have that in seeing what other things you could kind of do also. I do have a couple quick questions.
Yeah.
Yitzi's asking, if you depreciate over 5 years, what happens in year 6? I know you're talking about depreciation.
Well, it depends. If you're taking the bonus depreciation in the first year, then you're done depreciating the 5-year property. You're just going to depreciate the 27.5 year, whatever's left. So you're taking a chunk of it, you depreciate the chunk of it in the beginning to reduce your tax liability. And then once you're done with that, you just continue depreciating the 27.5 year, which is a lower amount.
And Garudi's asking, is the max limit of the cost depreciation, is there a max limit of the cost depreciation you can claim for the given year?
If there's a max in depreciation, no, you can take as much as you want. Well, if sometimes it happens where you take depreciation in excess of your income. So in that case, I mean, you may have a negative. You may have let's say a negative 100,000. You have a loss. Then you pay no taxes, but you don't lose that loss. It just carries forward to future years. So even if let's just say that in this example, this client, we were able to identify 52,000 additional depreciation, but he only had $30,000 in income, right? So that brings his income to zero, negative 20 actually. So he pays no tax, and that loss, the negative 20, just rolls forward. So you never really lose it, right? I always tell people, I think the cost segregation, it's great in multiple ways because you're reducing your tax liability. At the same time, you're also identifying and I'm going to go over the details, what the cost seg looks like, because it shows you the components individually, like what they're worth. So you can also use that report when you're doing rehabs. When you do a rehab, you can say, you can just say to yourself, hey, I'm replacing doors, I'm replacing windows. So now let me go back to this slide. I'll give you the example. So let's just say that you replace the roof when you're doing a rehab, right? This roof is identified as 14,500. So what a lot of rehabbers do, what I've seen is that they may, now this is going to be for rehabbers that are landlords, right? Because if you're flipping it doesn't matter. There is no cost seg there. But if you're a landlord that you're rehabbing a property and you replace the roof, normally what happens is you add the new roof as an asset that you want to depreciate over 27.5 years, right? So you're depreciating the new asset, but you're not removing the old asset that you replaced. You're not expensing it. And most accountants will miss this. Most accountants will just say, okay, show me the receipt for the new roof. Okay, you pay 30,000, 20,000. Okay, we're going to add it, start depreciating it from this year forward. but they don't do anything with the old roof. The old roof is not there anymore. So you now with this cost seg, you can identify the value of the roof and depreciate it and expense it as a disposed asset, right? So that's a big deal because a lot of people just miss things that they have replaced or fixed, and it just doesn't get expensed. So it has a double benefit: the tax savings, and then also the list of assets that you can expense if you're replacing them. Make sense?
Absolutely.
So we have like a
Um,
couple of people maybe doing cost segs now. Not a lot of
yeah, I was
people.
yeah, I just think it's funny that I see a couple people are doing it. I'm just surprised you're not doing it on all your properties. If you're doing it on one, you should probably do them on all of them. Obviously, it can't be your primary residence. Um, William's got a question. What about taxes on a property from a different state? I have 20 acres of rural property that I inherited in Oklahoma. So I guess
Taxes.
if you own properties, yeah, I'm assuming it's
Well,
if
if
you
it's
own properties in different states.
yeah, I mean, if it's just like a second home or a second property, I mean, property taxes are deductible
Yeah,
depending on
but
what you
I
do
think
with
it's
it.
I think maybe if you own a property, let's say you live in Florida, and William, I might be wrong on the way you're asking this, but if you inherit it and you sell it, right? Let's say he sells the 20 acres. Does it make a difference if it's in a different state when you're actually filing your taxes? Let's say you're based out of Florida, and maybe
Well,
that's the question.
right. So if you are selling property out of state, then if that state has state taxes, then you have to pay taxes in that state for the gain from that property, but only for that portion of income, not the entire. If you live in Florida, Florida has no state tax, so we enjoy the benefits of the sun and no state taxes down here. But if you do own property out of state in the state that has state taxes, you'll be paying taxes in that state only for the activity that you have in that state. Okay.
Yep, sounds good. What
Okay.
about, let's see,
Go ahead if you.
how do you know if the costs of having the cost segregation studies completed is worth it? So I know, depending on,
Yeah, that's a great
you
question.
know,
I always say, I mean, if you have $100,000 worth of property, it's probably not worth it. If it's over 100, I would say I like cost segregations. Nowadays, they're very inexpensive because they become so popular. We can do desktop cost segs nowadays on the smaller properties. If you need a cost segregation that's on a property that's under 500,000 and under 6 units, you can get that done for like 1,500. It's very inexpensive comparing to the benefit, right? So most of the time, it's gonna make sense. The tax savings are gonna be significant. It's gonna be way over $1,500, and you also get the benefit of having the components of the property listed out, just like you see in my screen. So that's an additional benefit. Those are those are benefits that are, it's like the gift that keeps on giving, right? Like you get the tax benefit this year, and then when you do some rehabs and when you do some component replacement, you get an additional benefit because now you know how much to deduct. So it's very hard to say no to a cost segregation nowadays anyway, because they're so inexpensive. I hope that answers that.
absolutely.
All right. And
The,
then,
I know, well, I mean, I guess this is just a statement from Phyllis. She's just saying she needs to work backwards on her taxes because she's paying a large amount now. So she wants to invest to have write-offs. And she was a landlord, but she sold the building because she didn't have a good manager. What would you tell her, or what would you suggest? I know I would suggest to buy more properties, right? And then do cost segregation, or what
well,
have you seen with your top investors and what they're doing? How about that? That's probably a better
well,
question.
number one is you never sell, right? If you're an investor, you're an investor. Investors don't sell. And if you do sell, you call me because I will buy it from you. All right. So I'm also an investor. So investors don't sell.
Hey, wait, I'm an investor. No, I'll buy it. I'll pay $1 more than Jose does.
Yeah. I'll pay the extra dollar and I'll give you the tax advice. I win.
I'll raise you. I raise you. No, okay.
But anyway, so yeah, I mean, the advice really is investors don't sell. If you sell because for whatever reason, I mean, I understand that things happen. and sometimes you have to sell, right? Family problems, whatever the case is. Um, Keep in mind that if you sell, you're triggering a taxable event. And when you sell, you're going to have to recapture the depreciation that you took over the years, meaning that you're going to have to pay that back. On top of that, you're going to have to pay capital gains if there's a gain between the basis of your property and what you sell it for. So it's never recommended to sell. I always tell my clients that if you have children, especially if you have children, right? And 100 years from now, you're no longer here. You're gone. Your property passes on to your heirs, your children, and they get a step up in basis. What does that mean? That means that if you purchased a building for 500,000, or let's just say a million, if it's a large enough building, you purchased it for a million. You've been depreciating that million over the years while you've owned it, right? So you've been getting the benefits of the depreciation, accelerated depreciation, cost segregation. You've been paying very little to no tax during the years that you've owned it and you've been on this earth. You pass on, your kids get it at a step up in basis. And up until now, we have a step up in basis of 10 million, almost 11.5 million, right? So let's just say that 100 years from now, that building is worth now 10 million. So your kids are going to get a step up in basis to 10 million and not pay any taxes on the difference from what you bought it for, and they got it, right? So that is a huge plus. That's a huge benefit. And that's how generational, multi-generational wealth is created, just by bypassing that tax, capital gains tax on appreciated assets when you pass on. So yeah, my advice to investors is always not to sell. I mean, and if you do have to sell, you can use a 1031 exchange, which Biden is talking about taking away, which is ridiculous. So we'll see what happens with that. But 1031 exchange is great. It's a great tool to defer capital gains. There's also nowadays Trump's created the opportunity zones. If you are lucky enough to find units or property in the opportunity zones, these are capital gains that will be deferred forever. So basically forgiven after 10 years. The hard part there is finding property that you want in those opportunity zones because they're kind of scattered all over the world, all over the country. And you have to do your research, right? So I don't know if that was a long-winded answer to the question, but that's basically what I would do. Not sell, but being that you have sold, you're going to have a taxable event that you're going to have to deal with in 2020.
Absolutely. And 1031s, if you've been building your self-directed IRAs, that's another way too to keep paying, adding the portfolio. If it's in a Roth, obviously there's no taxes when you do sell, but the income's, tax-free also. So even
That's
if
a
it's
great
in a
point.
traditional,
Yeah.
if it's a traditional, that's okay too, right? You can still buy it in a traditional. You'll just have to wait to actually pay those other taxes down the road too. So
Yeah, no, that's a great point. I mean, if you're buying and selling property in your Roth, then any profits from the sale is not taxable. So it just
yep.
stays with your Roth. So there's no issues there. Okay. All right. The second page of this cost segregation is going to show you the list of assets for the personal property. So now the first page was the actual real estate, the 27.5 property. And now here we have listed the kitchen cabinets, the personal property, ceiling fans, appliances, blinds, appliance wiring. And then we have improvements, which are considered to be 15-year property. 15-year property is like site fencing, other improvements like sidewalks or driveways, things of that nature. All right. Okay, another important point to consider as investors is you really have to understand what's a repair versus an improvement. Okay, a repair is something that it's a quick fix. You're patching a wall, or it doesn't add value to the property. You're just kind of fixing something. An improvement is something that you're replacing an asset, you're replacing a component within the property that it's adding value to the property. And that gets depreciated over time, depending on what that improvement is. A repair gets expensed when the repair happens. So if you repair a hole in the wall in 2020 and you paid $500 to repair that, then that is expensed in 2020. If you spend $10,000 redoing your kitchen cabinets and countertops, that is not expensed in 2020. That gets depreciated over 5 years unless you use bonus depreciation at the rate of 100%. So when you summarize your income and expenses, do your advisor, your practitioner a favor. Don't assume everything is an expense. Separate the assets because they have to be reported separately. They don't get reported in the same place on the tax return. So you want to be able to quickly identify what's a repair and what's an improvement. Okay. I hope this is making sense. Type in the chat. This is great stuff. If you're getting it and you're enjoying it and you're learning some new things. All right. Now, another concept for you guys to understand is the investor term, right? If you look at the word investor, an investor is somebody who buys something with the expectation to make money in the future. A true investor buys and holds, right? I know that a lot of wholesalers and a lot of flippers, they call themselves investors, but by definition, they're not. They're dealers. Okay, so that's the biggest difference. An investor is going to buy something to hold. A dealer is going to buy something to flip. Okay, so the difference between the two is the way they're treated for tax purposes. An investor pays capital gains on any gains or capital losses on any losses. A dealer pays ordinary income on any gains, any profits, and any losses are ordinary losses. Okay, so it's good to understand, and you really have to have a clean line there, a clean separation between the two if you're doing both, because you don't want to muddy the water there. All right. So I always tell my clients, if you are a landlord and you're buying property, buy it under an LLC, not an S corp. Never use an S corp. If you learn anything out of this webinar today, never buy property under an S corp. It's a horrible strategy, and the IRS does not allow it, so it can get you in trouble. All right. Dealers, if you are a flipper or a wholesaler, you may want to operate under an S corp. Maybe not right away, depending on your net income. If you're netting anything anywhere 40, 50,000 or more, the S corp may be a good option for you. Not always though. You don't want to assume that there's no cookie. Anybody that tells you there's cookie cutter solutions for your business is either inexperienced or they're just flat out lying to you. So don't assume that everything is cookie cutter, because it's not. It's going to depend. All right. Let's see what else we have here. The real estate professional status is a good one. So real estate professional status, it's how many of you guys have heard of this real estate professional status? If you can type it in the chat, let me know. Because a lot of real estate professionals, realtors or wholesalers, they assume that they automatically qualify for the status, which is not the case. Okay.
Nope.
There are tests. I want to see how many people are heard of it. Yes. Okay. So a lot of people have heard of it. So a lot of people think because you're in real estate, they think that they qualify automatically, and that's not always true. There are tests that you have to meet. All right. One of the tests is that more than half of your personal services have to be in real estate trade or business. Okay. You have to materially participate in the real estate business, perform 750 hours of service a year. And if you want to qualify the properties for this, then you have to meet a third test. All right, so you automatically may qualify because you're in real estate, you're doing sales, you're doing acquisitions, you're doing construction, rehabbing, and you're doing it for more. This is your primary business, and you're doing it for more than 750 hours a year. So that qualifies you for the real estate professional status. A lot of people think by qualifying for this is going to benefit them. The property that they own, the losses that their landlords produce from the property are going to be offset against their active income, their ordinary income from sales of wholesaling or maybe real estate sales. And that's not always the case. The third part of this test is that you have to be able to elevate the passive loss to a non-passive loss. And that's where it gets tricky. Don't assume you qualify, because you have to participate in the management of that rental to elevate the passive to non-passive. Okay, so how do you elevate the passive to non-passive? Well, there are tests for that too. All right, material participation is a tricky thing. It's something that you have to track, and it's hours based. So you have to track the time that you're spending in your business at all times, just in case you get audited, right? It's not really going to go anywhere, but if you get audited, you need it. Okay, so these are the material participation tests. These are very I could spend hours talking about this because this is a very complex topic. But there are 7 tests, and the easiest, in my opinion, the easiest tests to meet are going to be each tax number 3. Each tax year, you participate in the activity for more than 100 hours, but your participation cannot be less than the participation of any other individual in the business. Meaning that if you own a fourplex and that fourplex is producing you $100,000 in losses because you did a cost segregation and you accelerated depreciation, whatever the case is, those losses can be elevated from passive losses, which are restricted or they're limited. You can't apply them to ordinary income depending on your income. You can elevate them to non-passive so that you can apply those losses to your ordinary income, which is a big deal, right? If you're in a 37% tax bracket, losses of 100,000, that's $37,000 in tax savings. So why wouldn't you want to use this strategy? So meaning you have to have 100 hours managing the property. All right. And what does that mean? You have to interview your tenants. You have to respond to their calls, their inquiries. You have to do the maintenance. You have to do the leases yourself, and you have to track the time. All right. And if you materially participate in the management of that property, now you have elevated the passive activity to, or not ordinary, but non-passive activity. All right. So that's one of the easiest tests. Then there's others. There's things like you got to participate more than 500 hours, and there's no other caveats there. You materially participated in the activity for at least 5 years out of the last 10 years. That qualifies you as well. So if you qualify, this can be very powerful if you're a landlord. And if you're a landlord that has ordinary income from other activities like a job, a W-2 job, well, if you have a W-2 job, you're probably not going to qualify because the majority of your time has to be spent in real estate. But if you are a wholesaler or you're a realtor doing sales, you're already in real estate. So this could benefit you greatly. All right. Okay, so as if those tests were not enough, there's actually more restrictions. So if you are an employee in a company, your hours aren't counted towards real estate. So let's say that I work for BRIA, right? If I was a BRIA employee, I'm in real estate because I'm doing acquisitions, I'm doing sales, whatever the case is. But if I'm not at least 5% owner, those hours cannot be counted towards the material participation for the real estate professional status. All right. Tasks like education and reviewing financials are not considered to be time spent in real estate. So anything that an investor would do of a business, it has to be physical activity in real estate, not management of a business, a real estate business. If you own multiple properties, like most landlords do, you have to meet the material participation test for each property in order to elevate that passive loss to non-passive loss. And that's pretty hard to do. All right, let's say that you have 20 properties. How do you explain spending 100 hours per property? It's a lot of time, right? So there is something for that. You can group the properties. Let's say you spent 10 hours in each property. And you have 20 properties, right? So that's 200 hours. So you can group them by making an election, which is the 1.469-9G. You make that election to group the properties and elevate the activity that way. But there's some caveats to that. That's a long conversation. Once you make the election, it stays grouped until the properties get removed or sold. So it's I always say that it's recommended not, and we're getting too technical, and I may be losing some of you, so I'm gonna move on. But the point is that you want to materially participate in each one of the properties, and if you have multiple properties, you have the option of grouping them, but it's not recommended. In my opinion, is not recommended. All right. Any questions you want to address, Anish? No?
Yep, give me 1 second here. Sorry about that. So we got a bunch of questions. So let's kind of, if you want to turn off your slide for a little bit, and let's just kind of chat for a little bit,
Sure.
because some of these things are opening up pretty quick. So, so Martin was asking back, goes back to cost segregation. Wouldn't 5 different cost segregation studies come up with 5 different results?
What, say that again. Ask me that question again.
He said, if you did 5 different cost segregation studies,
Mm-hmm.
right, wouldn't they have 5 different results? I'm not sure why you would do 5 different cost
Yeah,
studies on the same property, but
you
I
wouldn't
know
want
what
to.
he's asking in theory.
Yeah, you just need one cost segregation on each property, and that's it.
But I think what he's asking is, and I might be wrong on this, is that what happens if you did one, right, using your firm, and then he uses someone else? Are all the studies going to be the same, or is it going to be
No,
more like
because
an appraisal, right?
right,
Like an
because
appraisal.
it's kind of like same concept. I mean, anybody that does a cost seg they're gonna be different because and yeah, because everybody's gonna use a different measurement. People are gonna use a different potentially basis depending on what they capture as a basis. It depends on what you captured, and it's not necessarily wrong that they're different. It's just that when somebody prepared the cost segregation, these are the guidelines they use, and this is the information that person used, and it doesn't make it wrong. It just makes it different. This second person maybe used a different measurement, and they could be off by a couple dollars. It's not a cost segregation are estimates. It's an art. It's not a thing that's a fixed number that's always going to come out the same way. So whoever you use, whether you use one of these big engineering firms or your local tax advisor, um, it's fine. I mean, as long as you can back up the report, have some information backing up how you came up with those numbers, how you came up with the basis is really what you want to worry about. And
Absolutely.
and that's something that you don't want to do yourself, right? You want to understand the basis. You want to have your advisor understand what the basis is. All right.
Right. Martin's pretty funny. He's asking, what's the piece of art on your wall, Martin?
I got an octopus there. I feel
I
like an
know, but
octopus sometimes with like.
Martin's a very serious person. My favorite person, Anonymous. Can a Roth IRA be used to avoid dealer status?
Can a Roth IRA? Well, a Roth IRA is not an activity. A Roth IRA is an investment vehicle. So you're just buying investments in it.
Yeah. Again, like that would be, I would not tell you to run your regular operational business, all your deals to Roth. I would say no. What I personally do is I cherry pick the biggest ones to work through them. And then the other question is really like, I don't know how much money you have in your Roth, right? I don't know how many deals you could do at the same time. If let's say you have 200,000, you might only be able to do one deal at a time, realistically, unless you have millions. We do have hard money guys, including like Blander Mortgage, Equity Max. Some of the guys, they will actually also lend to Roth IRAs too. So it's non-recourse.
Yep.
Those are, when a non-recourse loan means that it's not personally guaranteed. So I just want to make sure. Eduardo is asking, can you use bonus depreciation for AC replacements?
AC replacements are considered 27 and a half years or 39 years. So no, that is not no. The answer is no.
Yep. Jorge is asking, if a buyer acquires a property that has been depreciated 10 years by the seller, does the new buyer get depreciation over 27 years or 17 years? So
Okay, they get it from year one because the buyer has nothing to do with the depreciation that the previous owner had.
absolutely.
So the owner selling the property that's been depreciated, they're gonna have to recapture depreciation, and depreciation restarts.
Yeah. So basically what that means, if Jose sold me the property, he's been depreciating for 20 years, 15 years, it doesn't make a difference to me.
the
because
buyer.
I'm the new buyer. So we basically start at year one. How does this strategy work when you also have a W-2? Can you have the status and have a W-2? So I'm not sure. That's a different question. So I'm not sure.
I think they're asking about the professional real estate status, right? It's
I think so.
it's hard to meet the requirements with having a W-2 job, because potentially you're already working 1,800 hours a year in real estate. So in order for you to qualify, you have to work 1,800 hours, 1,801 hours in real estate, right? Because you have to have more in real estate than anything else. So I don't think you can. It's kind of impossible unless you have a
Yeah.
part-time. If you have a part-time, then yeah, maybe.
Yeah, absolutely. Let's see. Garudo asks, so basically, if you own and manage all your rental properties, you could claim the real estate professional status.
Yes, as long as you meet the test. 750 hours and the majority of your time is spent in real estate.
Okay.
But if that's all you do, just keep in mind, if that's all you do is passive activity, then you may not have a need for the real estate professional status, because all
Right.
your activity is passive anyway. So there is no limitations. Yeah, passive income, let's say 100,000 in passive income, and potentially passive losses. So then that's the two. There's no, the characteristic of the income and loss is the same.
Okay. Steve's asking if you're just starting up, should it be an S corp or an LLC? Well, I guess it depends what you're doing. If
I,
I'm assuming if
you
you're
know, I
wholesaling.
that's a great question. I always tell clients when they're starting out, keep it simple. Do a single member LLC, taxes of sole proprietorship. Once you start making some money, then we can determine whether we need to convert that into something else. But to start out, save yourself the money and save yourself the headaches of the formality. Yeah.
Perfect. And Frederick's actually following up. You said that an investor should not own his properties through his S corp. When do you use the S corp then?
The S corp is not meant for asset holding. The S corp is more for an active business. So I have a tax advisory practice. My practice produces income. I have it under an S corp, right? Because I save on the self-employment tax to a certain degree. The the reason, there are multiple reasons why you don't want to own assets under the S corp. Number one is really you have a base. I mean, and this is going to sound complex, so I'm not going to get in too much detail. Do you have a basis issue when you buy? If you buy a property with a loan, normally if you buy it under your name, that loan is your basis too. But in an S corporation, you don't have basis. It's harder to transfer property in and out of the S corporation because it triggers capital gains. It triggers the capital a taxable event. That's number two. Number three is the IRS does not allow you to have passive income in excess of 25% of the gross income in an S corporation. So S corporations are not allowed to have more than 25% of their gross income be passive. If that happens, then you're hit with corporate tax rates, which right now they're 21%. And if it happens 3 years in a row, the IRS can terminate your S corporation, triggering another taxable event. So there are multiple reasons why you don't want to own assets under or buildings or real estate under an S corporation. Keep that in mind, because I see that a lot from new clients. I mean, successful landlords, investors call me and they'll come to me for advice, and they'll show me their tax returns, and I'll see that they own multiple properties under an S corp, and nobody's ever told them that that's not right. They shouldn't be doing it, and they've been doing it incorrectly for so many years. And luckily, the IRS is so overwhelmed with everything that they do that they don't catch it, right? But if they did, it would cost you a tremendous amount of money to deal with it. Okay, so these are things that happens on a day-to-day basis for an investor that's not well advised, well advised, I guess, right? So you want to make sure that you don't make those mistakes, because they can cost you a lot of money. Fixing those mistakes cost a lot of money. All right.
Yep.
That was a
So
long-winded
Josh,
answer, but I hope it helps.
I know these questions. It's so funny because you and I have had conversations for like on one topic for like 40 minutes.
Yeah.
So it's pretty easy for us to just be like, okay, well, it's this. And I know we have a lot of newbies on here. Again, today's really about general information.
Yeah.
So I know when I started, I didn't even know what questions to ask when I was actually speaking to a tax consultant or what's on the radar too. So Josh was asking, how does this info apply differently, if at all, for spec house development? If you're building spec houses, does any of this with depreciation?
Well, that's a brand, if it's yeah, right. So it's a brand new property, you still want to do a cost segregation. There's no difference. Yeah.
Okay.
Now
And
for
then
the
the follow.
newbies, go ahead.
Yeah. Go ahead. No, let's go for it.
No, I was just going to say for the newbies, the most important aspect of this webinar for them are going to be selecting the right entity, right? And don't overwhelm yourself with corporations, LLCs. Just get started with an LLC, single member LLC. We can always convert that in the future once you start making some money. For the more experienced people, the tax planning strategies are going to be qualifying for the real estate professional status, doing cost segregation if it applies to you. There's, depending on the activity, the level of activity you have and their level of income, there are more advanced strategies like shifting income, hiring your family, firing your children, to move some of that income to other tax brackets. There's also retirement accounts that we do, but the real estate professional status is going to be the most beneficial I think, out of all the strategies that we do. The cost segregation is very powerful.
Absolutely.
Having multiple entities sometimes is beneficial as well. I'm a fan of Wyoming. So, I mean, I personally have an LLC in Wyoming for different things. So we can get really complex in the planning, but it all depends on the level where you are in business, right? Where you are in income, where you are in assets, and where you want to go. So, like I said earlier, there's never a cookie cutter solution. This is very detailed. And what we do here, we specialize in tax planning and tax consulting. So the tax planning takes place in the very beginning of the relationship, and then everything else kind of just trickles down. We do the compliance for our clients and the ongoing maintenance.
Yep. Another question is, why can you claim the real estate professional status if you have a full-time job, but also manage all the properties you own? Because the 750-hour requirement seems attainable even if you have a full-time job. So 750 is what, 40 hours a week? That's 20 weeks, no? That's almost like, it's
14 hours
almost 18 weeks. Yeah,
something like
it's like
that.
that's 18 weeks. So 18 weeks is 18 weeks full-time. My question is, it might be attainable. Then, if you're working full-time too, it's going to add up. It's like
It's
almost
pretty
12.
hard to qualify when you're working full time.
Yeah, that's like 13 hours a week for 52 weeks, right? 50 weeks, basically.
Right. But then that's one part of the test. The second part is that more than 50% of your time has to be spent in real estate. So if you have 750 hours or 751 hours, and you have 800 hours doing something else, you don't qualify.
Got it.
Yeah.
Yeah, so you
That's why
definitely
it's
want to know
hard.
that.
That's why it's
Yeah,
hard when you have a job. It's hard to qualify. You have
Makes
to be in real
sense.
estate primarily. That's got to be your primary.
And Frederick's asked that my favorite question always is it better to own each property under a separate LLC or all properties under one LLC? I know you
That's
get
a
that
very
all the time.
common question. That we get that a lot. The answer is depends on who you ask, right? I mean, depends. So if you don't mind paying the annual report fees to the state every year, and that one LLC per property is fine. It offers you a little bit more protection, right? But it really, I mean, if you ask an attorney, they're going to tell you, yeah, one LLC per property. I'm okay with a couple per property.
Yeah, and I'm just going to add to that too. It's your threshold. You guys probably hear me say it all the time. It's like talking to your insurance guy. I always leave there, I feel like I never have enough insurance. If I had all the insurances that were out there, I'd have no money for, to live.
Right.
So each person's threshold's different. Again, if you put them in separate LLCs, right, you're gonna have to file a bunch of tax returns. That's number one. Same thing like what Jose is saying, you have to renew your corporation, the filing fees every year. It just depends. I mean, we have a couple of people that have over 100 properties, and their limit is, what they feel comfortable is 10 at a time. So they have, and there's a lot more complex structures that happen also. So it's kind of a loaded question.
Yeah.
So I mean, I know it's kind of hard. There's no cookie cut answer. Everyone, again, that's why I think it's just very different. And I hate to say it this way, is because like, especially like I see enough webinars and been to enough seminars, they just have one answer for you. And, my parents, especially since they're both accountants, they'd be so mad if I gave accounting advice and I'm not an accountant. You'll always hear me say, so what I've heard is this, but talk to Jose. And the thing is, because I don't know if you have 10 other properties, you have 4 other businesses. We have a lot of real estate investors that actually they're self-employed on different businesses. So what they're looking to do might be different from a person just owning 1 or 2 properties on the structures that they're looking at too. So I think it's kind of, I don't know. It's kind of a loaded question, I guess. Charlene said, she says, maybe I missed this, but when you say qualify as a real estate professional, is there an entity we need to submit information to?
No,
So,
that is selected at the tax return level. So when your advisor is preparing the return, is making that election that you are a real estate professional.
okay. And then India sounds like an experienced investor. Her question says, can you put each property in its own trust owned by a single LLC?
Can you? Yeah, sure.
Yeah.
Yeah.
And again, depends on what kind of trust is number one. I'm assuming a land trust. But it just depends what you're trying to do.
Yeah.
So
And
are you
then,
doing it to, find, I don't want to say hide your assets, but hide your identity is one different thing
anonymity.
versus,
Yeah.
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 So it's a lot more complicated, answer than one, but yes, you definitely could put it in.
Yeah. Anonymity is big. I mean, the Wyoming state LLCs are great because of the anonymity, nobody knows who owns it. And, that LLC can own different
Yeah.
LLCs in different states like Florida. And that's
You
a
know,
good way.
one of the biggest mistakes I see is that whether it's a land trust or opening up the LLC in Wyoming, then they use their personal home address.
Oh, yeah. Yeah.
Right? Or you're the managing member, right? So I know why you want to do those things is, you want to be anonymous, but you can't, put yourself as the managing member or your address or a family member. The whole idea is to have, you could be your attorney, your accountant, whoever you're using. Like they go so far and then they miss the point at the end.
Yeah. I mean, that usually happens when you do it yourself. We have a relationship with a Wyoming attorney where we set up LLCs in Wyoming. So if you guys are interested in anonymity, just because you want it, real reason. I mean, I have one.
Yeah.
We can help you get set up in Wyoming if you're
Yeah.
interested.
So I'm going to just answer the second part of that question that wasn't even asked, because my background is financing. As you put them in more complex structures, the chances of getting your money out, you own them free and clear, there's fewer lenders that will do different things. Automatically, if it's in an LLC, just be prepared, your loan to values will be different, is number one. Your interest rate will be higher. So you're not going to get Fannie Mae conventional rates of 3 or 4%. So like I've seen a bunch of people, hey, they put in these structures, great for one thing. Guess what? On the second end, if you're trying to cash out on these things, just be prepared. Your interest rate's going to be higher. The fees will be higher. And also, again, loan to value would be a little bit different. So they're thinking, I get this all the time, like, hey, I'm going to put it in the LLC. It's cashed out. I fixed it. I'm going to cash out my money and I'm going to get 3.5% on my financing. You're not. Right. Then they're wondering why they're getting 65% loan to value, or there's not enough equity. So just be prepared, like what your strategy is going to be.
Yeah, you can always, buy the property under your name and then deed it over to your LLC as a disregarded entity. A lot of banks will allow it, and some banks don't. It's just a matter of having that conversation with them.
Yeah. Because usually on those normal loans, there's a due on sale clause.
Mhm.
As soon as you transfer ownership, the reality is, and again, I'm not going to give you any legal advice. I could just tell you, I know a lot of people have done it. The
And
bank
been
did
fine,
not go
right?
after the due on sale clause, meaning as long as you're making payments, you're usually good. But again, you probably want to speak to an attorney before you do any of that stuff. But generally speaking, it's not an issue, but you do have to pay doc stamps too. So people don't add those costs too. So if you have a $250,000 loan, be prepared to when you transfer it over, you're going to pay well over $2,000 in transfer fees. That's stamps and also whatever attorney to set up your stuff too. So
Yeah, and don't just talk to any attorney either. You want to have somebody who understands real estate, and same
yeah,
concept as a tax advisor or an accountant. You don't want to go to a journalist. Journalists are not going to know what to do when it comes to real estate, for the most part, from what I've seen.
absolutely. Yep, absolutely. Martin's asking, how about serial LLCs? Not sure what he means by that. Do you,
Yeah, I'm not sure what you mean by serial LLCs, but I'm assuming you have multiple LLCs. You have
yeah,
multiple LLCs, disregarded entities. Yeah, and as a side note, if you have multiple LLCs as a disregarded entity, you don't have to do multiple tax returns then, because it flows over to
yeah,
the owner. So keep that
correct.
in mind. You could have multiple LLCs for your multiple properties. You would just have to pay the annual fee with the state to do the annual report. So that saves a little bit.
Yep. And Joshua, is it okay to own property LLCs under a trust? LLCs under a
Yeah,
trust.
property LLC under a trust. Normally is the other way around. Normally you own it under a
Yeah,
trust, and the trust is owned by the LLC.
LLC.
Yeah.
Yeah, I was trying to figure that out too. Like,
Yeah.
yeah,
So
I would say like, yeah, we're almost done here too. And luckily we got through all the questions and stuff. I just think that don't be so complicated. I don't know. Like, I know people are like, it's easy to read a lot of stuff, be on bigger pockets, watch seminars. And one of the things that drives me nuts a little bit in the beginning also, especially newbies, is they want all this asset protection and they want all this other stuff. And I know people are selling these things from $8,000 to $15,000. And
yeah,
the first joke I always make is, well, Jose, what do you have any assets?
yeah.
No.
What are you
I said,
protecting?
okay. Yeah, what are you protecting? No, they told me I need that.
Yeah.
So just be careful on that portion. I know there's a lot of great strategies. Do deals first.
Yeah.
I don't know how else to say that, right? Like and we want you to be set up the right way, but you don't have to go all in on some of these asset protection things that I've seen. As I mentioned, I've seen it from anywhere from $8,000 to $15,000 on asset protection,
Yeah.
and they're literally a newbie, and they're trying to do that, and then they don't have any marketing money
Right.
to even do deals, right? So I think it's the balance is probably what I would tell everyone.
Yeah. Focus on making money. I mean, if you're a newbie, focus on making money. And if you're already experienced, focus on keeping some of that money, right? That's when the tax planning comes into place. But yeah, focus on making money, not so much
Absolutely.
on
So,
spending it before you get started. That's why it hurts a lot of people too. Like they'll spend 10 grand setting up an entity for protection purposes, but they're not making money yet. So you want to focus on making money, keep it simple, do an LLC. The LLC is good enough to get started. Call us if you need help.
yeah,
And
Jose, do you want to put in the chat your information? And so I know he touched on certain things today. If you're interested in setting up an appointment with Jose, do you have
yeah,
a
we're
link or
we're gonna offer a 30-minute complimentary consultation if you guys are interested in having a tax strategy, going over your situation to see if we can help you with tax planning.
yeah,
So,
and so here's the deal, right? One of the things I mean, I'm the one that worked this out with Jose, for our members and our team to actually do this. What I'm going to ask from you guys, if you do the 30-minute, let's just, and it's easy. I know this happens to me. It's easy to talk about the world and everything that's going on. What about this? What about in the world of if? The idea is, where are you now and what are you looking to do? Because it's going to be a 30-minute hard stop. Jose is super nice, and what I can't have him do is now it's 20 minutes, and it's like, well, I heard about this and I heard about that, right? Just be, hey, this is my situation. I have 5 to 10 properties. This is, I'm doing no cost segregation. Is there a way, or what would you suggest? And have those properties ready,
Right.
so that he could really kind of work that with you. If you're new, right? Hey, what kind of corporation should I do and why, right? How many people are on your team? Have you already filed something through Sunbiz and now you're not doing minutes, or, you might have filed a corporation, it might not be the right one, right? So what we're asking, from you guys, if you do the 30-minute and he puts that in for you, just be aware he's got, he's doing this, I don't want to say as a favor, but he knows I push him to the, I try to get an hour. He started at 15 minutes and then we
You met in
agreed
the
on
middle,
30.
right?
So, I just want to, I mean, he's a huge resource. So just be prepared for that appointment is what is the
Yeah,
best way I would ask.
things that I would need during the conversation, during the call, I would need to know your gross income, your net income, your salary if you have a salary. I would need to know things like family size, you have children, if you're doing any retirement planning, how many properties you own, when you bought them, how much you paid for them, what you're depreciating. So have that information in front of you when we talk, so take advantage of the time that I'm giving you. I'm giving you 30 minutes of my time. Don't waste it. Is what we're trying to say, right? You want to get the most out of it by being prepared. Okay.
Yeah. Yeah. I just think it's important and you'll see because you're going to have very specific questions and including that, your specific goals, like what you're planning on. Hey, listen, I own a few properties, but I'm looking to, get into wholesaling or, I was thinking about selling these properties or whatever it is, right? I'm starting a company with my brother. Just have those questions in there. So again, to take advantage of that time with Jose versus a lot of what if this, and that's really what the webinar is more is let me ask those general questions
Yeah.
so we can kind of touch on them too. So,
Right.
so we
Excellent.
did put Jose's info in the chat.
Yeah.
So and advisors, is that where they could set up your
Yep. That link
30-minute?
says Advanced Tax Advisors slash webinar. That's where
Yeah.
you
The
they
first
can
30 people?
Yep.
Yeah, the first 30 people that sign up get the 30-minute in there. I am going to ask another thing also is that if you've already done a 30-minute with them, I don't know, what do you want to do with? I'm fine with it. I just don't know. Like, I don't want like, they're like, they
Um,
should just set up an appointment with you in general
yeah,
then,
I mean, depends on what we talked about. I mean, if there's any follow up information that we need to talk about, then that's fine. But if there isn't, then you can just call me during tax season if you need
Oh,
help with
you know
your
what,
compliance.
Jose, actually, you only put it to the panelists.
Oh,
Can
is that what
you
it is?
actually, I already have your info, thanks, so.
Yeah, you don't need it. Hold on a second.
Do you mind hitting it where it's all attendees also? Hey, thanks for letting us know,
Yeah, thanks.
Alberto. And look, these people are listening.
Hey, they're paying attention. That's good.
There you go. So advance, just give me a thumbs up or something so I know that you guys can actually see his info.
And let me know if you thought this information was helpful, this conversation that we had and a couple of strategies when we went over. I know that we're limited on time, so there's so much more we can talk about, but an hour and a half
Yeah,
is never enough to cover everything.
absolutely.
Let me know what you thought. Put it in the chat.
Yeah.
Great stuff. Not so great. Whatever. I
Yeah,
want to hear it
we're
all.
big boys, so it's not going to
You
hurt
can
our
take it.
feelings. Yeah, and the thing is, like, the funny part is, like, because we really want to hear from you guys because, again, like we added a Jose for I don't know, it's like the third time in a few months or fourth time, and that's because you guys, people were asking, hey, we want to hear more about this. So even if you guys email me privately, saying, hey, other topics, if it's not just Jose, other vendors, if we have someone on our team that's that we could talk about, we would gladly add it on. So for us, it's pretty easy. Also, after this webinar, you'll probably get a quick email from me. Hopefully, you'll give us a 5-star review and Jose a 5-star review. It basically goes on our Google reviews. Let us know what's happening on the seminar, what you like about it,
Yeah,
what
that'd
you
be
like
great.
about Bria. If you don't like what we're doing, email me privately and let me know where we dropped the ball. I mean, that's the truth. So,
Yeah.
like again, we're a work in progress. I feel like we've gotten a lot better with the webinars because we've done so many. So, but it's a learning thing for us too. So, and then the last thing also, our webinar will be back on our YouTube channel. It's the Broward Real Estate Investors Association. The webinar will be on within 48 hours. Usually it'll be on by tomorrow, but we always talk about 48 hours too. So
Yeah. And I will put it on my website as well. So if you go to advancedtaxadvisors.net and then click on webinars, you'll be able to see all the webinars we've been doing. I'm trying to get, more technological and fancier with
you and
my.
I, we're laughing. Us, yeah, we have the same thing. We know how to flip houses. I know you're accounting. The technology sometimes we're a
Yeah.
little challenged, but
Okay.
thanks for bearing with us, today. And Jose, any last words or anything that you guys got?
No, I look forward to speaking to you, and keep in mind that a lot of these tax planning strategies have to be implemented before the year end. So if there's something pressing that you
Yeah,
think you need to address, if you're facing a big tax bill this year, definitely book a call, because there's some things that we still move around to mitigate that tax liability. Don't wait till January 1st, because it may be too late for most. There are a couple things we can do after January, but not a lot. All right.
absolutely. And I want to thank you guys. Ryan and I want to thank you guys. Actually, next week this weekend, if we might see some of you guys because we're doing our boot camp,
Yep.
2 full days.
I'll be there.
If you still want to sign up for that, go to bria.com, upcoming events, or actually briabootcamp.com, and you can still sign up for that. It's A to Z, how to flip a house all day, Saturday, Sunday. Next Tuesday, I'll be doing a webinar for member benefits. We always got these questions about what do I get as a member at Bria? Some of those discounts at Home Depot, Office Depot, Arcana, Rent Perfect, it's free. If you're a member and you're not using your benefits, you're probably going to want to be on there. If you're not a member and you're saying, what the heck are the benefits? Maybe I will join these guys, come on there. And if I don't see you guys before the holidays, we want to wish you guys a happy holidays. We want to wish you, safety and health for your family. I know it's been a crazy year, 2020. I know we're all sick of it. Like, I'm sick of this COVID stuff. I'm sick of everything. So I feel like there's light at the end of the tunnel, in general. And it's really going to be a good time. We're very biased, but it's going to be a really good time to be in real estate investing. We're already starting to see some great things. And we'll joke about it. And the cool thing is, now that we have these recordings, I feel like in 5 years, Jose, we'll be drinking some whiskey, and we're going to be talking about, remember 2021 and 2020, what a mess it was. And man, those were the good old days of how we were flipping properties and making money too. So don't let all this stuff get you down, right? I mean, there's always going to be obstacles in your life. And Ryan and I and Jose, we always think there's enough room for everyone to do well. So I just want to thank you guys again for joining us, and hopefully we'll see you guys, some of you guys this weekend, some of you guys next Tuesday too. So
Excellent.
thanks, guys.
Well, thank you guys. Thank you, Anish.
Yep, take care.
All right.